Hey listeners, today we had on Kyle Samani, co-founder and managing partner of OG Solana investor Multicoin Capital. We chatted about non-crypto assets coming on chain, Kyle's qualms with Ethereum, and some of his more out there ideas for this year. Also, a little plug that if you like this episode, Kyle and I will actually be speaking on stage alongside Solana co-founder Anatoly Yakovenko at the Blockworks DAS conference in March. Use the code Lightspeed10 for 10% off your tickets at checkout. Although our guest this week is a managing partner of a registered investment advisor, nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice. We'll dive into it in just a second. This episode is brought to you by Ledger, the most secure hardware wallet trusted by 7 million users and securing 20% of the world's digital assets. We'll be hearing more from them later in the show. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanek, alongside Mert Mumtaz, and we're joined today once again by Kyle Samani, the co-founder and managing partner of Multicoin Capital, early Solana investor, and Kyle's just a really interesting thinker. Kyle, thanks for coming back on the show.
Jack, thanks for having me back. Mert, good to see you again.
Well, I thought it'd be fun with all the talk about DeepSeek to use Perplexity and feed it your blog post and then use DeepSeek's reasoning model to summarize the post and then generate questions for me. So I'm going to summarize it very quickly.
You're telling me you're too lazy to do your own job. That's what I'm hearing right now.
That's correct. Absolutely. Very short. This blog post outlines Solana's evolution into a foundational layer for, quote, internet capital markets, unquote, positioning it to outperform TradFi in speed, cost, and accessibility while enabling newer financial primitives. Key arguments include cost reduction, market efficiency, expanding TAM, and MEV capture. Would you agree with the summary of that? Can you summarize it in your own words if the overlords missed anything there?
Our Chinese overlords were it was pretty crude. Honestly, that was pretty weak. I mean, it was nothing was incorrect. It just didn't say anything of substance. I'm guessing it doesn't know a lot about MEV and a lot of the other term lingo in there. The intent of the blog post and why I wrote it was, Solana's $100 billion asset today, 130, whatever, something like that, and nice big round number. And I'm optimistic it can get to $1 trillion. And obviously that's a big jump, and a lot of people rightfully should be very skeptical. Very few assets in human history get to those levels. And so I tried to distill our own internal thoughts on how can you buy this asset at the $100 billion, thinking it can get to $1 trillion. We explicitly chose not to build a financial model because the inputs into the model would be number of assets and trading volumes and growth rates of those things, and MEV capture from those things. And all of those are I don't know how to project the growth rates. I mean, Pump is producing 1 million tokens a week right now, but that's up from 1,000 tokens a week a year ago. And so we just don't know how to model growth rates with any degree of precision. And we have a pretty firm rule, at the firm that we don't want to project false degrees of precision. So we didn't build a financial model, although that's kind of what you would expect, but rather just wanted to help people understand, hey, if this thing is going to get to $1 trillion, why is that going to be the case? And what are the core drivers that are going to get you there?
Looking at the piece more broadly, first of all, Mert, that was an unhinged first question to lead with. I love it.
That's how he runs Helios now too. He just fucking go someone sends him a question, he just puts it in DeepSeek, and that's how Helios runs on autopilot now.
Yeah. DeepSeek didn't want to talk about the Tiananmen Square anecdote in the blog post either. But looking at it more broadly, I did actually read it. I did not have AI just summarize it. I
reviewed it. I read
the Mert did review it. He's even got a tag at the bottom.
Okay, that's fair. You talk, Kyle, something that was new to me in this piece is you basically say there's payments and financial services are the two things that you can do on these blockchain asset ledgers, and payments are a loss leader. So to my understanding, something that isn't very lucrative financially, but it just gets a lot of users in the door that can pay for other things. But where the money is in financial services, because blockchains can be valued based on how much MEV they produce. And I just hadn't really seen those ideas laid out in that way. So maybe I'll just start with like the first piece. Why is it that payments are loss leaders, and should, people that are building payment infrastructure providers be concerned about that?
I mean, payments are loss leaders in the sense that, like, again, if we're going to get to $1 trillion market cap or even $100 billion of market cap, where are the profits coming from to get you there? And the answer objectively is MEV today. And like Solana's current, PE ratio, so to speak, is not crazy. It's like in the 30 range based on like annualizing a quarter's, 90 days of revenue. So we're not talking crazy numbers. It's aggressive, but not crazy. But if you look at like what's contributing to that 30 PE, it's 99.9% MEV and 0.1% payments in terms of like gas spend. And so I'm just rounding that last bit to zero. I just don't care. And so that's the core. When I say loss leader, that's kind of what I'm referring to. But payments are obviously important because in order to have financial assets trading, people need to have assets, and obviously people, and like most things, trade against USD. And so obviously the more USD is on chain, the more trading volume is on chain, the more it's just natural for people to send USD to other people. And obviously sending money to other people is inherently viral. If Alice sends money to Bob, Bob sends money to Carol, Carol sends money to Dave, like obviously you are onboarding, new people by definition. So I look at the payment stuff as helping the growth of the financial services stuff, but in terms of where is the money coming from, to soul holders, that's all going to come from financial, Wall Street financial services.
I got another quote for you, Kyle. So this one is a quote tweet on your post. Counterintuitively, decentralization enables takers to minimize latency for time to transaction inclusion, and therefore maximizes information propagation in financial services. Decentralized price discovery is by definition better than centralized price discovery. The world is a big, heterogeneous place. To which QW from Alliance replied, completely incorrect. And he said, a maker is usually also a taker. If a maker somehow has an unfair advantage in market making, there's no reason why they can't also market take. The statement that Kyle made basically tells me he doesn't understand how price discovery works. What's your response?
Yeah, Chad and I have had a bunch of private Telegram chats about this since then. I looked at it from first principles, like there is information produced in the world. That information moves financial markets. That information is not all produced in New Jersey where, NYSE and NASDAQ are. That information is but produced everywhere. And so I don't know. I don't fully understand Chow's claim, but like very intuitively, if you want to minimize the time between where information is produced and that information impacting financial markets, then you obviously want to minimize latency between those two things. That's just naturally true. And the beauty of Solana, as we get to multiple concurrent leaders, is you can have multiple venues that can accept transactions. And so if there's a piece of information that comes out in Singapore, sending that to New Jersey is going to take, a quarter of a second or whatever it is. But if there was a server that was updating the price of Tesla or whatever the asset is in Singapore, then you would get the information to the server, faster. Call it 200 milliseconds faster, or whatever that might be. And so, it's just natural. Like, reduce distance, like you reduce latency. Period. That is called efficiency in financial markets.
But that is also contingent on some like downstream or some future updates to Solana, right? Like in the current
Correct.
400 millisecond block time single leader world, that it wouldn't be at like faster to update financial markets.
That's definitely correct. Solana needs to get to a future state that there's people working on called multiple concurrent leaders, And the idea would be obviously there's multiple leaders at the same time, but we're a good ways away from that.
Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your Solana and logins, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a robust ecosystem of products and services, making digital ownership more secure and accessible to everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, feature the world's first secure touchscreens, making it easier and safer to manage your Solana transactions and coins. With Ledger Live, you can seamlessly and securely manage and stake your SOL. Alongside Ledger Stacks and Ledger Flex, Ledger introduced the Ledger Security Key app, a safer alternative to traditional passwords, enhancing your overall digital security. Thank you to Ledger for making today's episode possible.
Talking about the new things, one of the new things that's actually live today is something called Conditional Liquidity, which you mentioned in the blog post. I don't think many people are aware of this term. I mean, it's really just order flow segmentation, but especially within crypto and Solana, I don't think many people are aware. So can you maybe explain, you explained to me a while ago, can you explain it for the layperson, how it works, what it is, and how it fits in the context of the thesis?
Yeah. So conditional liquidity is the ability to quote different prices to different people based on some condition. The condition in question, for the purposes of what we're talking about, is where did the transaction originate from? And you can think, broadly speaking, all transactions originate from one of two places. Either there is a human who is clicking the buttons on the screen on Phantom or Soulflare or Fuse or whatever, or there's even an AI, using simulating that, but still going through the manual clicks on the screen. Or you've got a bot somewhere that's got a private key that's just signing messages and firing them off. And the primary bots naturally have a lot of advantages that humans do not have, obviously, in terms of speed just being the most obvious one. And so the idea of conditional liquidity is, hey, can we quote different prices to different people? And specifically, can we quote tighter spreads to humans clicking buttons and wider spreads to bots? And you might say, well, why is that fair? There's a very natural reason as an external observer to say that feels wrong. Why are you trying to discriminate prices? Two answers to that. One, I prefer humans getting better prices at the expense of bots. That's like an ideological statement, one that I hold, and that I think most natural people also hold, because most people don't run bot armies. And two, this norm is already the standard in many financial markets, including U.S. equities. In U.S. equities, a lot of retail trades on Robinhood, and there's been extensive studies done over the last decade looking at the average prices that Robinhood traders get versus the average prices that are quoted on NYSE or NASDAQ. And very definitively, Robinhood has proven over the course of trillions of dollars of trades that they can quote better prices for retail users. And so I look at this as like, if our goal is decentralization and democratization of finance, I want to get better prices to retail users. The cost of that is higher prices for sophisticated market actors. Those two things are directly in conflict with one another. But I believe that if our goal is truly to democratize finance, that is the trade-off I want to make, and that I'm pretty sure 99% of people also want to make for fairly obvious reasons.
So 99% of people may want to democratize finance, but in the current world, for the Citadels and even the Robinhoods, I guess, just the big financial institutions that benefit off of the incumbent system, I guess, what's the incentive for them to change? Because, if prices are currently propagated in New Jersey or whatever, and a lot of the world's capital markets are based in New Jersey, then why would there be incentive for them to switch and make it fairer for a retail trader in Singapore to be able to beat them on a trade or something like that?
Oh, there's no incentive for them to switch, but their opinion doesn't matter. What matters is where the retail users are, and also what the retail users do. So let me break this apart across a few dimensions. One is in the context of conditional liquidity, the people whose opinion really matters are the wallets and the application developers. And if the wallets and the application developers wants to improve prices for their users, then they are incentivized to implement conditional liquidity and like order routing to like capture that stuff. I think as a general statement, most application developers are. Some of them move with different degrees of urgency and speed and whatever. But like if you're building an app, generally you want better prices for your users. And there's nothing that the market makers can do about that. Market makers will always go to retail users, period. In the context of MCL and being beaten by the random guy in Singapore, again, what matters there is, are there retail users who want to trade Tesla on chain? And if those people exist and they want to trade Tesla on chain, then that is going to create this nice side effect where now retail can actually, even one sophisticated guy in Singapore can still beat Citadel in New Jersey.
I was going to ask a different question, but your last sentence reminds me of something. If retail people want to trade Tesla on chain, then, and by the way, I believe Larry Fink the other day said something about all bonds and stocks should be tokenized, to which I forget his name, but one of the Bloomberg guys basically said, LOL, I can already do this. I don't need the chain for this. What do you think is still the biggest barrier? Because you talk to both institutions and founders and all sorts of different people. I just talk to weird people on Twitter. What is the biggest barrier for those TradFi assets actually going on chain rails?
The biggest barrier to getting them on chain is some combination of issuers, although there's lots of companies like Denari and others working on that. I'm not super worried about the supply side. The bigger question is figuring out how to find the people who want to trade on chain and who can't currently access those assets and getting them there. And so like, for example, I have a theory that probably today there's a lot of people who want to trade NVIDIA with leverage because of like AI stuff happening, or want to trade Google or Apple or Tesla with leverage. Today the DeFi perps teams are not providing that for regulatory reasons. I'm optimistic that will change in the next 24 months, but we'll see. On the spot issuer side, I suspect as that happens, I think the spot issuer side will naturally come along with it because market makers will then want to be able to hedge using spot as well. So I think the forces are there. Probably it's going to be degen led, degen traders with leverage, traders who are trading with leverage. I think will likely be the ones that pull the initial liquidity on chain, and then from there, will create broader accessibility for more people. Then if you're the random guy who wants to just build a stock brokerage in Colombia or in India or whatever, once you know the Apple and the Google stock is there with enough liquidity, it's much easier to go build an app for end user customer acquisition. So there's a natural chicken and egg here. It's not exactly clear how the chicken and egg gets solved, but I feel like the winds are blowing in the right direction.
Got it. That makes sense. There is a question in there around why, let's say, hypothetically assuming this happens, why people would do it on Solana as opposed to other chains that are perhaps more perp-centric, but I will probably not go there. Or maybe we can in a bit. Which brings me to one question, though. You mentioned atomic composability in the article. And the last time I went on Twitter around atomic composability, I recall a post by Vitalik saying that atomic composability is overrated. Why do you think atomic composability matters, and is it overrated?
It is overrated relative to what I thought, let's say 3 years ago. I don't know exactly what Vitalik's opinions are. The more I have come to think about Solana versus a web of L2s. The problem is not like strictly a function of atomic composability. It's more a question of risk management. Spot trading across chains is not intractable. Like companies like Lefi and others make it pretty good. Now you still have like the key management problem of like all of the keys across the chains, and that's harder for wallets to implement. Although at this point, Phantom and others have done a pretty good job with fairly broad key management support. The bigger problem is when you go beyond spot trading to anything in which you're depositing collateral and managing risk. So borrow lend protocols and derivatives being the two very big obvious places. And those systems are just objectively way worse when you have a smattering of them replicated across all chains. Having 10 instances of Aave across 10 EVM environments is really terrible. It's less capital efficient, interest rates are wider, spreads are higher, liquidations are going to be slower and more heterogeneous. There's going to be fewer people competing for them because it's just they don't have capital on chain. More people are going to get blown out because they didn't manage their collateral correctly. So that's a really terrible configuration. And it is the default one in Ethereum land today, and I don't really see a way to undo that. That is going to be extremely difficult to unwind that reality. Now, you could say, well, you could have one global risk engine and collateral can be deposited on all the chains. And then whenever liquidations need to happen, you send messages between them. And this idea has been around theoretically for obviously 4 or 5 years at this point. To the best of my knowledge, no one is even attempting to build such a system because it's just really scary as a risk manager to build. And like, who wants to be the guy who builds the system that you get some cascading liquidations and bad debt because the people who build these systems are extremely risk averse, as they should be, because the number one thing you have to prevent is bad debt liquidations. And like the safest way to do that is to one instance per chain. So I think, but then there's a few like downstream effects of that, which is obviously you have all of these assets in these borrow lend and derivatives protocols all replicated across many EVMs. Well, now the on-chain liquidity available for those liquidations is all worse, right? And the UI management is worse. And so, capital markets are not the notion of app. The reason app chain is this dumb word is because none of these apps are actually independent. There's only one app in all of crypto, which is just money movement. And because of the nature of capital markets, when something happens with this risk pair between the assets X and Y, then that will always have ramifications on the rest of capital markets. And the more you fragment the capital markets, the more things just don't work right. And that's what you see in Ethereum land today. And I don't really understand how to fix it.
And just to briefly extend that, I feel like every few months I see a new quote unquote omni-chain network or something along those lines that looks at this very real problem of liquidity as too fragmented and says, hey, we're going to be the base layer where you can move between assets. And I don't exactly get why like one of them hasn't caught on yet, because if you do try to move funds around on chain and you're trading on both like Base and Solana, it's pretty bad UX. So just as an investor, why do you think none of these startups have really become the marquee one, at least in my view?
Well, there's a lot of levels to this problem. First, there's like the individual wallet level. Let's say Phantom or Soulflare or MetaMask or whatever. And for them to do it correctly, there's a few things you need. One is obviously you need key support for the different chains. You need all the UI elements to populate correctly. And then if you implement something like Lefi, you can at least make spot trading work well. But then that starts to break when you get into anything more complex. So like, let's just say you have a big pile of USDC on on Base, and you want to deposit that as collateral on Drift on Solana. So you go to the Drift UI in Phantom, or if you're on your desktop, you go to drift.trade, whatever. And like Drift doesn't currently have, at least to the best of my knowledge, an API that like knows to detect USDC on all of your other chains to accept deposits. And so my point in highlighting this is that even if Phantom implemented everything correctly, that is not enough to make the UX seamless, because you need every app to also implement, I'm going to call it the chain abstraction API correctly to deliver that butter experience. There's not one chain abstraction API. I know Near coined the term, I guess, a year and a half ago. I like the term generally. There's no specific scientific definition as to what it means. And I know Near has their own approach on how they're trying to solve this. One of our portfolio companies is called fun.xyz, and they actually provide the API that I just described, that Drift could theoretically implement. I know Polymarket has it implemented today. And then obviously the other parts of that are like, well, what if you want to like not deposit your USDC that you have on Base, but you want to just like send in a wire, right? There's all these different ways you could want to get collateral into Drift. So my point is that the chain abstraction problem is quite difficult. That's one level of it. Well, there's two levels kind of there. One is wallet layer, second is app layer, and then the third is I am sending assets to some other person or place. And so it's like, okay, I have USDC on Base. Let's say I'm trying to send it to I have a friend has a different wallet. Let's say I'm on Phantom, my friend has Fuse. Well, Fuse doesn't support USDC on Base at all. There's no EVM support. And so they're like, send me some USDC, like I'm paying you back for dinner. And like, the receiver is going to be like, here's my address. And as of now, I'm assuming Phantom will not detect that automatically and use CCTP or something else to like bridge the USDC over, so you can send it to your friend on Fuse. Is that implementable? Yes. But again, it just creates more complexity for all of these things to work right. And so this goes back to the thing I just said a few minutes ago, which is none of these things should be viewed as independent applications, at least at the chain level. Obviously, at the iOS home screen level, like there's a fucking icon, you click the icon, clearly that's an app. But when we're talking about back-end money movement systems, there's only one global app. It's money movement or asset value movement. And that's why these things are so hard. And that's also why I'm very skeptical that you're going to get this right across EVM land, because there's so many different versions of all of this stuff and different forks. And you have different now roll up as a service providers. And like the people in the US do something, and then like Binance and BNB chain, it's EVM, but like they have their weird fucking quirks into it. And then OKX is doing their own whatever thing. And so you get so many implementation differences that it's kind of impossible to make chain abstraction work in a universal way, because the number of different UX flows is a lot. And in my view, the only correct way to do this is to minimize the surface area, or actually minimize the number of standards that basically everyone is communicating over. And in the case of Solana, that's an N of one, which is just Solana mainnet.
Talking about EVM, I have a two-part question. I'll ask the first one. So Hayden from Uniswap tweeted, honestly, I thought about an EIP that buys out top DeFi projects, and I'll choose with a one-time ETH inflation. What interesting concept. And you quote tweeted, you can try to be ultrasound money or you can try to compete with Solana. You can't be both. This proposal, while actually quite interesting, immediately destroys all credibility as ultrasound money. Can you expand on that?
Yeah, so the proposal, I don't think this is the formal proposal. I think this is just kind of like people spitballing on Twitter. But it's an interesting one, which is like, we have all of these things that we now recognize compete with Ethereum, literally the L2s. You could argue Uniswap whatever. You can get very creative with your definitions here. But clearly there's all of these things that are theoretically need to be Ethereum aligned, but that practically are not, because they all have their own tokens, all of their own token distributions. All of these entrepreneurs and VCs are all swimming in different directions because like the assets are different. And so the theory is do a one-time discretionary inflation of ETH and buy out all these other people. Meaning trade all of their respective tokens for ETH. And presumably in that instance, all of those people now become ETH aligned because now they've done this. Ignore all of the like mechanical complexity and like the fact there's no drag along rights and all this other shit. And obviously the gameability of this would be very high. It's interesting because like nominally ETH aligns everyone, but then also it's just like, well, yeah, but we still have Arbitrum and Optimism and Base and all of those things still exist. I guess we're all asset aligned, but like there's still the pride ego stuff of like, well, Arbitrum guys spent 3 years, working on their thing. The Optimism guys spent 3 years working on their thing. I don't know. Are they all going to actually agree to some interop standard? I don't know. I don't know. So I flag it as just like, I don't think it actually solves the problem because there's more than financial alignment. There's like ego alignment and stuff. And then the other part of my tweet was basically like, if you were to do this, you can't be credibly neutral. One-time discretionary inflation to like effectively bribe other people to like be aligned is just like the definition of not neutral, because that's inherently biased around a moment in time, which would be the moment in time that like you do the transaction. And obviously it wildly rewards the people who defected from Ethereum to build these other systems to come back, which is also just like kind of insane to think about. And anyone who's going to try and evaluate ETH as credibly neutral money or as a credibly neutral store of value is just going to laugh. Because this is just so wildly subjective. Yeah. To be clear, I don't think this is going to become a real proposal. Not that I'm like deep in ETH land. Obviously, I'm not. Nor do I think it will get much traction. And I think even if it were to pass, I actually still don't think it's going to enable Ethereum to effectively compete with Solana. But it is a very fun, interesting intellectual experiment.
Great answer. The second part of my question, you've been on the show before talking about why you think Solana will flip Ethereum and all meaningful things. It seems like actually a fair amount of those has happened in the past few months, except for the market cap. You do have a new saying that seems to agitate certain people in Ethereum, which is the future of Ethereum is Coinbase. What does this mean? Can you expand on it?
Yeah, it's my observation of a few things. One is having a bunch of EVM L2s that are all effectively functionally equivalent. Again, on the margin, there may be 0.1 or 0.2% differences here and there, but like objectively, they're 99% the same. Having many of them is just dumb. And there's going to be a natural coalescence towards one for all the reasons we spoke about earlier. Liquidity and all this other stuff. UX and liquidity pools and debt obligations and liquidation, all this stuff. There is a natural tendency for one. And then two, Coinbase can, to some extent, help Base in a way that Off-Chain Labs cannot help Arbitrum, or in which OP Foundation cannot help OP Mainnet. Those are real. I don't think they're super important, but definitely non-zero. And then three, and probably most importantly, and actually also most sadly, a lot of people say the words, oh, if I build on Base, I'll get natural distribution from Coinbase. And that statement is objectively nonsense. But a lot of people say it. And so it's a shelling point and it's a self-fulfilling prophecy. And so those three variables combined led me to recognize I probably tweeted that like 15 times in the last 12 months, maybe 10 times. I've tweeted it quite a few times. Probably the first time about a year ago. And I recognized those three things were self-reinforcing. And so I was like, all right, I think the future, the dominant L2 on Ethereum is most likely to be Base. And since I started tweeting that, Base has taken all of the market share of the L2. I mean, not all, but it is clearly directly taking market share from all of the other L2s by a very wide margin.
Do you think Base is going to launch a token?
I think they want to. It is unclear if we're going to get the securities laws. If they are to do it, it's going to be very interesting from a securities law perspective. I think the easiest would be like just send one Base token to all the Coinbase shareholders as basically like a dividend. The problem with that is like presumably all the Base users are going to feel really pissed in that situation. And if you inflate the Base supply and don't give 100% of it to Coinbase shareholders, that is the definition, I think, of securities fraud. And I think they will be sued left and right. And I'm guessing whatever judge ends up overseeing that case is like going to side on the side of the shareholders. So it's just extremely messy legally. I'm fairly plugged in the stuff we're like Fit 21, what we're trying to get through U.S. Congress this year, and I don't think anything in Fit 21 addresses this problem. And so I think they want to do it. I just like as a practical statement, don't know how they will do it.
Something I wanted to get into a little bit in our earlier conversation about Solana internet capital markets is sandwich attacks. Because, you talk a lot about traditional regulated kind of securities coming on chain. And one thing that the SEC does care about a lot is things like front running, and like using, information advantages to, in a predatory way, give traders worse prices and things like that. We also know that Solana has a bit of a sandwich attack problem where that very thing is kind of happening. I think conditional liquidity gets at this a little bit, but I don't know. What's your general take maybe on A, how sandwiching is solved, and then B, does sandwich attacking become an obstacle to more regulated institutional kinds of capital coming on chain?
Let me answer part B and then I'll come back to part A. So part two was how do you get traditional TradFi assets trading on chain given the existence of sandwiching? I'm actually not very worried about that. The sandwiching that happens overwhelmingly on crypto native assets, primarily meme coins, trading on AMM curves, because all meme coins are traded on AMM curves. Like that is the default liquidity distribution mechanism. And for meme coins, that is actually very sensible for a bunch of reasons. If you start trading Tesla on chain, I don't think anyone is depositing Tesla shares into an AMM. To the extent market makers are trading it, they're going to quote it using discrete orders or using a limit order book. Sandwiching over a CLOB is not impossible, but it is like 99% harder to sandwich over a CLOB. So that just naturally will solve the problem for TradFi assets. For this is part of your question. The other part of your question was just like, how do we solve sandwiching more generally? The answer is a lot of things. Conditional liquidity is part of the answer. The Ellipsis guys made a sandwich-resistant AMM. Obviously, moving more towards CLOBs helps. Although, again, meme coins, I think, will always be dominant on AMMs, not CLOBs. That will help. Reducing block times will help. Implementing more RFQs will help. And all of these things will happen, are happening, at the same time. And so there's like the market is getting more efficient. And there's like, call it 5 or 6 different vectors of efficiency that are all, naturally rolling out. I think by the end of this year, the discussion of sandwich, I think the amount of sandwiching happening will actually be like substantial. It will be small enough that it will no longer be a major PR item.
Bold bet. Let's see how it plays out. I want to get to, you guys also published another blog post, well, two actually, around 2025, and Something's Never Changed, and the other one was Frontier Ideas. I want to get to that, so just setting up the context. The one thing I would like an explanation on, in your Internet Capital Markets article, you say that these crypto systems can reduce fees by up to 99% compared to traditional rails. And I think we all know this to be somewhat intuitively true. There's cost savings there, less middlemen, et cetera. But how would you describe it? What actually makes up those cost savings, and how realistic do you think that is, given that some of those costs actually just are a result of certain regulatory aspects of traditional finance?
The root of the cost savings comes from trust. The entirety of financial market infrastructure in the United States and abroad is based on different roots of trust. The most important root of trust is the U.S. Federal Reserve. Other roots of trust include the DTCC for U.S. equities. I actually don't even know how commodities exactly are tracked. And then there's other central banks, obviously all around the world, BOJ, ECB, etc. Those are all their own respective roots of trust. The equities and commodities markets in each of these places have their own roots of trust. All of those roots of trust are human institutions, and all of those roots of trust have generally, technically speaking, those roots of trust are inherently malleable as a function of the humans who control their respective databases. And then they're also all, generally speaking, shit in terms of technology. Most of them are, what's it called? Whatever, old IBM databases, or why am I forgetting that terrible language? Yeah, mainframes and stuff like that.
COBOL.
COBOL. That's the one I was thinking of. Thank you, Mert. That's a large majority of them, at least by dollar volume. And sticking together roots of trust and maintaining APIs does create costs. And the people running most of those roots of trust are also not capitalists. Or I should say, are not CEOs with a profit motive tied to the operational efficiency of their respective operations. The Federal Reserve chair does not make more money if he makes the Federal Reserve APIs better and more efficient in 24/7. Although that would benefit the lives of Americans, but he actually doesn't profit, and so it doesn't happen, even though it should. So that was a long rant on past, and then on future. Because we have trust minimized systems, we get rid of basically all of the bullshit, and we allow the cost of money movements to collapse to the cost of the physical silicon and the electrons. And very intuitively, the cost of those electrons is damn near close to zero. And so that's the core source of the arbitrage.
I do want to get to these frontier ideas because I'm sick of the current use cases in crypto. You outlined, well, Multicoin has an entire blog post on it, but your section particularly for 2025 Frontier Ideas, you mentioned two things: DePIN robotics and zero employee companies. Can you expand on both of these?
Yeah, so DePIN is a very, we love the idea of the capital formation of people in the world who are passionate about some area, whether it's mapping or telecom or AI, GPUs or energy, whatever, can participate in these networks and gain financial upside. And as we think about the evolution of AI and transformers, the area that's honestly the most interesting to me is physical world robotics, and using AI, transformer-based AI, in terms of vision and manipulation and dexterity and control. And training those robots is going to require a lot of data. And so it strikes me that there's a big opportunity to use the DePIN style capital formation framework to collect that training data to make these robots better and better and better. There's at least one example I'm aware of that does this today. It's called Fertobots. I believe the guy's name is Michael. He's based, I believe, in Singapore, if I'm not mistaken. We've known him for at least a year now. And he's doing like sidewalk delivery robots. It's super cool. You should check it out. There's a whole fun game around it too. I think there's going to be a lot more versions of that same idea. So we want to see more of those. The second idea of the zero employee company, I got inspired to write it because of all of this discussion of like AI agents, meme coin meta. And I was like, I started to really think and talk really closely with my partner Cheyenne. And what we kind of realized, we were like, well, the logical end state of all of this is that you have a company that is an AI. And the AI will start to hire people to do stuff that it cannot do itself, presumably using crypto rails as its primary financial rails. And the AI will need guidance and governance because none of the models today, I don't believe, can recursively update indefinitely without like losing kind of the track correctly, for lack of a better word. And so you're going to need some sort of human guidance overlay. And that human guidance will be doing, it may update objectives. The humans may say, hey, you explored this one area, maybe try explore this other area. There may be a value statement. Don't interact with the Chinese Communist Party, even if you think that's the cheapest way to achieve objective X, as a value statement. So I believe humans will guide these things. And I believe that's a very powerful idea. The reason it's relevant to crypto is I believe that the capital formation to back these things is obviously going to happen on crypto rails because the idea is so compelling on a global basis that I think you'll be able to raise way more money at a way lower cost of capital for the AI using crypto rails than you will from any traditional venture or private equity firm. And I think there's going to be a natural, obviously, interest in the public kind of like following this thing along to see like what it does. So that's generally what we're pretty excited about. The one entire area I will caveat out of this as generally not interesting are AI hedge funds, or for lack of a better word, AI trading bots. Yes, technically a hedge fund is a company. I run a hedge fund, but like the trivial form of zero employee company that we are seeing launched now are AI trading bots. But strictly being a financial markets participant is like not particularly interesting to me. Being able to have objectives that are more than trade to increase your account balance is where it gets a lot more interesting.
I want to ask you about crypto venture, Kyle. The bull market is definitely back, but the kind of like ultra frothy rounds that you saw in maybe 2021, 22 haven't returned in my view. I mean, I guess Phantom just raised 150 million, but it's a very established business. So I don't know. I guess where do you foresee the crypto venture market going during this cycle, and how might that look differently from 2021, 22?
My one would answer that I don't know. I don't care. Because I don't give a shit about other venture firms. Like, okay, do your own fucking thing. Like, I'll focus on on my venture firm. Thank you very much. Will people get stupid and overfund stuff? Probably that tends to happen. I feel like the new L1 infrastructure thing has got to die, and like somehow it keeps not dying. So that one perplexes me. I can tell you what we're focused on is a lot of the ideas in the blog post that just mentioned, and then on the liquid side, my best how we think about the world is don't think so hard. Look at the trends that are now very clearly working. The meta one of importance to me is Solana, and then like look at all of the things up the stack from Sol, and like pick your favorite ones and go long those if you believe that they're the breakout winners. I'll pick on Jito specifically. clearly they are the dominant block engine on Solana today. Clearly they're a relevant player in the MEV stack, and widely adopted and used and recognized. And like, don't think so hard. Just go, like, own the things that are working. Once you recognize e-commerce, like let's assume you started using e-commerce in the year 2004, and you're like, wow, this Amazon thing is great. Just like fucking go along Amazon, and it's like, yeah, are more people going to shop online? Yeah. If you search on Google in 2004, it's like, are more people going to search on Google? This is a really useful service. And so my recommendation is don't think so hard.
Succinctly, one might say just left curve it based on that. So just do not mid curve shit. Well, I have two other questions, final questions, and they're unrelated, so bear with me. One is, what do you make of the ETF filings, especially with the new admin? What do you I've always had a hard time explaining why an ETF actually matters because I don't do finance. I just put the blocks in the database. Why is this important? What do you make of these new ETFs for Solana coming soon?
Why do they matter? There are a lot of people who are just not going to sign up for a Phantom address or a Coinbase account or a Kraken account. They already have all of their money at E-Trade, Morgan Stanley, Goldman, whatever. And they're just, for mechanical and lazy reasons, not going to move. And also for incentive reasons, if you have a wealth manager at Fidelity, at Schwab, at Morgan, Goldman, wherever your place is, they are incentivized to not tell you to move your money to Coinbase to go buy Bitcoin or Solana or whatever. Once the ETF exists, now they can still take their fees and you can still access that asset. And so, in a very objective statement, the ETF expands the universe of buyers for an asset. No questions asked, that is true, for mechanical reasons and for bad incentive reasons, or I should say fixing those bad incentives. So that's why it's important. And then, like, what do I think of the current filings and the applications? Don't know. I'm not an ETF expert. If you want to understand if, when, and or how is most likely to happen, I would encourage you to check your local poly market. As I would say, the crowd is smarter than me.
Good answer. Okay. Final question for me today. So, Kyle, you told me not to buy these, but I did buy them anyways. They're called Sol Reader, and it has nothing to do with the asset Sol. It's literally just wearable glasses with e-ink screens. And I got them, and they suck, and they're not good. However, I'm trying to make the best of it, so I'm looking to buy some books. What is one book you'd recommend to people joining Multicoin? The best one?
Hard Thing About Hard Things, Ben Horowitz. That one's up there for me.
Already read it.
All right. David Sachs and Peter Thiel's book from 1995, The Diversity Myth. I read that one over the holidays. That was a fun, dude. It's wild. I mean, they document extensively how Stanford in the late 80s and the early 90s, like the woke day shit. And I'm like, wow. A, that it was happening because it was that far back. And B, that they wrote it all down, put it in a fucking book, and like told everyone, y'all are a bunch of fucking crazy, diversity socialists. In 1995. Like, insane.
You know what's funny about that? There actually is a podcast from another Solana-related thing that's not Solana-related, Mike Solana, the head of marketing at Founders Fund, and he interviews Peter Thiel on that exact book. And so if you want to check that out, there's a podcast on it. And that's all I got.
I think we're going to wrap it there. But Kyle, thank you so much for coming on the show. We got into a lot of interesting stuff, and it was very interesting to hear your perspective as usual. And we'll have to have you on very soon. Best of luck with all the stuff you're working on.
Hey, Jack, Mert, thanks for having me on. Pleasure to be back.
Absolutely. Take care.